Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya. Let's get to some of the stories we're following for you in the BNN Bloomberg newsroom. Cogeco is taking a charge of $1.7 billion related to its U.S. telecom business. The company owns BreezeLine, an internet, cellular, and TV operator in multiple American states, as well as Wello, an internet provider. It says the non-cash impairment reflects the competitive environment it operates in the U.S. Cogeco also says this will not affect its cash flow or day-to-day operations. Apotex has launched its IPO. The Canadian drug maker plans to issue as many as 50 million shares at a price range of $20 to $24 apiece. The company is seeking to raise up to $1.2 billion in total. The IPO comes nearly a decade after the unsolved murder of Apotex founder Barry Sherman and his wife Honey in December 2017. And Berkshire Hathaway is buying homebuilder Taylor Morrison in a $6.8 billion U.S. deal. The acquisition marks one of the first major strategic deals under new CEO Greg Abel. Analysts say Berkshire is betting the housing cycle will turn and that there's pent-up demand in the market. And we're keeping an eye on U.S. futures this morning. All seem to be in the green as traders are kind of weighing what's happening in the Middle East. We'll keep an eye on that for you. We're also watching the TSX. It made some pretty significant gains last week, finishing just below 35,000 points, roughly below. Keep watching that for you today. We're also watching the price of oil. It is rising from a 6-week low amid uncertainty over a deal between the U.S. and Iran. It's up almost 3% to start the morning. NVIDIA is taking direct aim at Intel and AMD, announcing it will enter the PC market with a new chip designed for the AI era. Joining us for more now is Marianne Bartel, Chief Investment Strategist at Sanctuary Wealth. It's great to have you join us. Thanks so much.
Thank you for having me.
I think, first of all, can you just maybe explain to our viewers what exactly this chip is and what does modernizing the PC mean for users?
Well, I'm not a semiconductor analyst, but what I can say about the semiconductor industry is it's the leadership here in the U.S. It's the leadership sector. And as long as semiconductors can lead this market, we remain in a major bull market. And so it's not, there is a story of AI, and the chip is very important for that, but it's important for all things. We live in a digital world today where, the satellites that we're putting up in space need chips, our vehicles that we drive need chips, and even some of the appliances that we have in our houses now have chips. And that's aside from, our computers and our phones. Semiconductor chips are really the critical component in technology. I always call them the brains of technology, and they're just in their early phases. Now, many, or there are a few, not many, that are very extended right now in terms of their price performance. So you can get sharp pullbacks. But the leadership, I still think, can last the next couple of years. We're not near capacity, and that's what you want to watch for. Are we reaching capacity? Will the demand ebb? And it's, we're really in the early phases where demand is just insatiable for these chips.
For sure. And this is the second time now that NVIDIA is making a push into the PC market after its last attempt fizzled about a decade ago. What's different this time? And why could this attempt succeed when it didn't before?
Well, again, I'm not a semiconductor analyst. Yes. I'm a market strategist. But Jensen Huang has actually shown that he's the leader. He created the AI chip, allowing a whole new way of computing. But it's not the only way. And I guess now they're trying to reconsider. There are other chips that will be in high demand, the CPU chip, not just the GPU chip. And they believe they have the technology to be able to do that. So now they're trying to enter that market. So it is a competitive market. There are, select leaders. But as you're seeing, memory right now is scarce. So you're seeing the memory chips really go on a tear. An example would be Micron, which is a leader in that space. So I think you're going to continue to see a lot of competition in the space, particularly as demand remains elevated and supply actually is under what's the word that I'm looking for? Under supply constraints.
Constraints, yeah. And speaking of the market side of things now, like, what do you expect to see in terms of how investors will respond to this? Do you think NVIDIA will be rewarded?
Well, I think NVIDIA is just a leader, right? They've created the AI chip, and they actually traded sideways for about 6 months as other chips advanced, and that's because NVIDIA had already priced in a lot and needed some time to absorb those gains. But I think NVIDIA stays the leader. I don't think they're anywhere near a top in their price action. I still think there's significant upside potential in the company.
Okay, I want to move on and talk about SpaceX, because I know there's a lot of conversation around that right now as we await for this potential IPO, potentially coming this month. And obviously, index providers rewriting the rules here. Passive funds are modeling huge inflows. There's a lot of hype around this IPO in particular. What does all this tell you about demand? And what is this a defining moment when it comes to, the market with IPOs?
Well, I've been in the market for 40 years, and this is probably the most popular IPO that's coming to market. And, it's large. It's going to be going in indices earlier than most IPOs go into indices. And Elon Musk is a famous person, a very popular person with very strong followers. And so I do expect this to be a very popular IPO. And you also have this year OpenAI and Anthropic, which are expected. And, I still think this is the early phase of actually starting an IPO, as in our market, many companies have decided to stay public longer. So I do think that there's a lot of demand to have access to new companies. So it's going to be very interesting how this IPO goes. We recently had an IPO with a company, and it was a semiconductor company called Cebris. And on the open, on the first day, the stock was able to rally 100%. And I think that was a clear sign of the insatiable demand we have for companies to go public, since so many of them have stayed private. So I think all eyes, not just here in the United States, but globally, are going to be on this IPO.
Just before we wrap up here, taking a broader look at the markets, I wanted to talk about gold, because you still believe gold is a good hedge against inflation. Obviously, it's been used for that in the past. Why do you still feel that way?
So, gold serves many different functions. Obviously, it serves as an inflation hedge. We're seeing central banks really add to their reserves. Now, some have sold, but there are still others that are adding. And I think over time, you'll continue to see central banks add to their gold reserves. Whenever we have heightened political volatility, gold tends to go up. And we need interest rates to go down. I think one of the things that's holding gold down is that we've seen interest rates here rise in the United States. And I do think in time we'll have the ability to see interest rates come down. And that will be a positive. In all the years that I've been on Wall Street, I've never talked about gold being a hedge in a portfolio, because we had a deflationary cycle in the United States. And now I think we've entered, since about 2022, 2021, an inflationary cycle. And gold has proven over time that it can be a hedge in times of inflation. So I do think that investors can hold gold. And my long-term target on gold is 10,000. So I do continue to see significant upside over time in gold.
Okay, we'll leave it there. Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Appreciate your time. Thanks for joining us.
Thank you.
Coming up on Friday, GDP data showed Canada is in a recession. We'll look at how consumer confidence is holding up when we come back. Stay with us. On Friday, Canada's GDP data showed that the country is in a recession with 2 consecutive quarters of contraction. Here to tell us about how consumer confidence is holding up is Nick Nanos, Chief Data Scientist at Nanos Research Corporation. Good morning. It's so great to have you join us once again.
Great to see you.
So consumer confidence down 1 point over the week. How significant a drop is that?
Well, the thing is that consumer confidence has been weak for almost more than a year. And we're basically at the neutral point. It's at around 50.7 out of the 100-point scale, which means it's almost perfectly neutral. It speaks to the fact that many Canadians are holding their breath, wondering what the future will have in store in terms of the economy. And, the kicker is there's a significant regional variation. Mm-hmm. In the province of Ontario, the industrial heartland of the country, it is in negative territory. Consumer confidence is at 45 points out of 100, and it probably speaks to the uncertainty in the binational relationship.
Yeah, I was going to ask you about that, right? Because Ontario's seeing the lowest confidence at the moment.
Yeah.
Is it because as you say, there's so much industry in this province? Like, what do you think the reasons are for Ontario being the lowest?
I think from an industrial manufacturing perspective and from a services perspective, Ontario is probably one of the provinces that is the most integrated with the United States in the Michigan, Ohio, Indiana economies. And it speaks to the fact that it's a top priority for Premier Ford in order to have certainty on that binational relationship. And I think for a lot of Ontarians, they're wondering, where will the trade relationship be, not just in 6 months, but in a year, in 5 years, and where there'll be some type of certainty. Because right now, that's all we know is that there is uncertainty. People do not know where we'll be in 6 months or a year on the trade front. And I think that particular anxiety probably touches a raw nerve among consumers in Ontario.
Which parts of the country have the highest consumer confidence at the moment?
Actually, Quebec has the highest. It's at around 58 on the 100-point scale. I think a lot of that has to do with the fact that, Quebec basically, because of its renewable energy, the hydroelectric kind of exports to the United States, they're actually in a pretty strong position because the United States does need that, and there is a commitment in terms of all of those agreements. So, the consumer confidence in Quebec is the highest. And, when you get beyond Quebec, you can see kind of the prairies and kind of middle territory. But I think the key takeaway here, the outlier is Ontario. And considering the importance of Ontario to the national economy, that should be very worrisome.
For sure. Worker confidence in job security dropped by more than any other category. Maybe you can explain that category in particular and what that tells us about views on the labor market right now.
Well, we asked Canadians how secure or unsecure they are in terms of their job, and about 68%, if I recall correctly, said that they were secure, somewhat secure. And we've seen that security number been moving, a lot of it having to do with what Donald Trump is saying, and especially when he targets specific industries. And, the thing is that even when the Prime Minister talks about diversifying the economy, basically what that means is that a signal for change, that the Canadian economy has to change to be more resilient. And whenever people hear about change, they wonder about what it means for their own jobs. And, the thing is those job security numbers, are at around 68%. In terms of confidence or feeling secure nationally, but they're lower in the province of Ontario. And this goes back to what we were talking about. What will happen to the automotive sector? What will happen to the industrial sector in Ontario? Where will it be in 5 or 10 years after the trade situation settles into the new normal that no one knows what it'll be?
Yeah, for sure. There's just so much uncertainty right now, right? When it comes to expectations of improvement to personal finances, that fell to 11.5%, so that's down 1.3 points. What does that tell you right now about how people are feeling?
Well, the movement is within the margin of error, but, the key thing here is that when we ask Canadians whether they think their personal finances are better or worse, the better number, as you mentioned, is at around 11%. The worst number is 45, which means Canadians are basically 4 times more likely to think that their personal finances are worse off rather than better off compared to a year ago. And it speaks to kind of the dark cloud for a lot of Canadians when they're thinking about the rising cost of living, the rising cost of gas, the rising cost of housing, rising cost of buying groceries, and how they're feeling the pinch when it comes to their personal finances and how they're trying to manage this, the rising cost of living.
And then, of course, too, we're just listing all the ways Canadians are feeling really not confident in the economy. But when it comes to the Canadian economy, that confidence down over the week. What signals in the broader data might be contributing to how people are feeling in that aspect?
Well, yeah, only about 18%, or about a little less than 1 out of every 5 Canadians believe the economy will get stronger in the next 6 months, while I think about 47% believe that the economy will get weaker. And it speaks to that kind of that undertone. There is one positive piece of news, Lindsay, in the numbers, and that has to do with real estate. You know, we ask Canadians whether they think the value of real estate in their neighborhoods will increase or decrease. About 40% of Canadians believe that the value will increase. 18% think that it'll decrease. A bit of an upward movement on that front. And, you know, usually the increased numbers in the last 10 years have been the strongest part of Canadian consumer confidence. And, you know, we've seen the increase of housing prices on that front. So it's dropped significantly, but even at the numbers that they are today, it's up, I believe, about 4 percentage points in the last 4 weeks.
Interesting. Okay, so I was going to ask you, I do always like to ask you about some good news. You did have some for me, so that's great. But when it comes to consumer confidence, it now has a reading of 50.7 in your index. I wonder what that means, and particularly if that number would go below 50 or drop to below 50.
Well, you know, recently it has dropped below 50. And, you know, the fact of the matter is over the past year, it's been sputtering in neutral somewhere between 45 and 55. Over this period where Canadians are unsure about the future trade and economic relationship with the United States. So what this means is that they haven't gone significantly negative. It's kind of like people are holding their breath, wondering what's going to happen in terms of the Canadian economy. That's all they do know, is that there will be change. They don't know what that change will be. Whether it's dealing with the Canadian economy becoming more diversified and resilient, or that change related to the relationship with the United States. They don't know what that change will be, but they know that there will be change. And when there's change, there's always anxiety. What we have to worry about are Canadians delaying purchases, right? That this psychology, right, of anxiety converts into consumer behavior where people delay purchasing a pickup truck, even though they can afford a pickup truck and they want a pickup truck, but they just figure this might not be a good time. That's the danger in this next phase of tracking of consumer confidence, that Canadians start delaying purchases, and that creates a negative cascading impact on the GDP numbers.
Okay, we'll have to watch for that. Nick Nanos, Chief Data Scientist at Nanos Research Corporation. Always great to have you on. Thanks so much.
Bye-bye.
Up next, artificial intelligence is rapidly reshaping how businesses operate. So how fast is the corporate workplace really changing? We'll have more on that after the break. Artificial intelligence is moving from hype to everyday reality for many companies, transforming how work gets done across industries. Rob Hiller, Deloitte's Asia Pacific CEO, joins TTS on Bloomberg to discuss how AI is being integrated into the workforce across Asia and around the world.
Asia Pacific is where most of the great innovation that the world depends on for AI is being announced and is being developed and being exported to the rest of the world. I'm both a realist and an optimist. First of all, I'm a realist because technology is changing the way work is done. I'm a little more cautious that we're actually seeing the evidence of job losses. I know in Deloitte, we are taking on record numbers of graduates, and we're investing more than ever in training those graduates for work of the future. But I do know that in the tertiary sector, right across the region, universities are struggling to make the move to be able to put AI into the core of the way that students approach the workforce. And in fact, too many students see AI as cheating. They're taught that AI is something that is used for cheating, and so therefore they come into the workforce already with a negative perception. We have to change that.
How do you change that perception? Because the issue of regulation, of guardrails, keeping on top of the technology is quite troublesome.
First of all, more than 80% in our surveys of organisations are investing heavily in AI. And I know, as you said in the lead-in, a lot of people are still struggling to get the returns. But the reality is, you know, whether it is in customer service, whether it's in fraud detection, whether it's in coding of systems, you know, we are seeing those really substantial returns. And regulators right across Asia Pacific are watching very closely, are getting on top of. Yeah, we've seen waves of technology before that are disruptive to the way people work. In many cases, we've actually managed the transition reasonably well. Where I am today in Australia, we had a major car industry which resulted in the move of a couple of 100,000 workers out of the car manufacturing into new jobs that actually, with government support, was handled quite well with hindsight, but it was disruptive. We've got to learn from those experiences of the past and make sure that we make this as smooth as we possibly can.
It's interesting, the conversation around both reskilling, but also the fact that AI is not going to necessarily eliminate the need for human traits and human strengths, right? We have this great story on the Bloomberg today talking about how the rise of AI has made summer internship season that much more difficult and challenging because so many of these companies are opting for these tasks to be perhaps more efficiently completed by AI. Does a trend like this really threaten to remove what is core to particularly the sort of employee experience at those lower levels in order to be able to get to a point where there's more talent at those higher levels?
Well, this is the reason why we've invested in a physical AI centre in Shanghai, a smart factory in Tokyo, an innovation centre in Bangalore, is because the only way you design the work of the future is by actually working hands-on with the technology, with seeing how you can get the most effective interface between people and machine. You remember decades ago we used to have typing pools of people who were typing documents and producing them, and that went away with the word processor, and yet that work continued. What actually ended up happening was that work got embedded in the day-to-day process. That's what's happening with AI. AI is getting embedded in the way that we provide a customer service. AI is getting embedded in the way a programmer redesigns an activity or an outcome for someone to deliver. And AI is getting embedded in the supply chain to make it more efficient, but usually in partnership with a person. So we're going to see a lot of redesign and perhaps the first generation of jobs partnering between physical robots, back office AI and people are not going to be the final view of what work will look like. And it's going to be a really fascinating journey over the next few years as we make this transition.
Okay, stay with us. The opening bells are next. We'll be right back. Welcome back. Here are the opening bells at the NASDAQ. BlackLine is ringing the opening bell this morning. On the New York Stock Exchange, FedEx Freight Holding Company is ringing the opening bell. It's time now for the first 15. This is BNN Bloomberg. Trading is just getting underway, so we will check in on the equity markets to start your morning. The TSX starting the day down by 0.2%. We'll see if it can rally a little later today. Same with the U.S. markets, and this comes after the S&P 500 and the NASDAQ both reached new record highs when closing on Friday. So we'll continue to watch those for you. Obviously, there's a lot of uncertainty right now in so many ways, but particularly in the Middle East. We're hearing talks of maybe a peace deal coming between the U.S. and Iran, but we've been hearing that for a while. So it seems as though a lot of investors are very cautious about what might be happening there and continuing to drive up oil prices. We're watching a couple of companies on the TSX this morning. Apotex is one that we are watching closely. This comes because Apotex is launching its IPO today. It plans to issue as many as 50 million shares at a price range of $20 to $24 a piece. So we're continuing to watch that for you. And another company we're watching is Athabasca Oil. Athabasca has announced a new $500 million 4-year credit facility, and it's expanded the Duvernay Energy Credit Facility. It's believed these new credit facilities will enhance Athabasca's capital structure with expanded liquidity, enhanced durability, and a lower cost of capital. And so far this morning, Athabasca up almost 5% to start the day after quite a climb throughout the year, obviously. So we'll continue to watch that for you. We're also watching movers south of the border. And to do that, we're going to bring in Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities team. Jeff, good morning. Great to have you back. So you're starting with IBM shares today. Shares are jumping after an old clip of Donald Trump, who was mentioning the stock, I believe, was it last year, is now circulating once again. What's going on here?
That is correct. Yeah, very odd one this morning, and kind of encapsulates the amount of, I guess, exuberance in the market. So IBM shares were up as much as 15% in the pre-market session. And it's worth watching over the course of the trading day. A lot of sources and a lot of people in the market don't realize that this clip of Donald Trump speaking to the CEO of IBM saying that you must think your stock price is going to go up a lot more and talking about how well the stock is done, they think that that's recent. But in fact, it is not. It's from December. That was enough. Yeah, you look at the shares today. So still up 5%. Not 15, but still pretty good for something that happened, 5.5 months ago. This is a clip that was repurposed, reheated, retweeted, whatever you want to call it, by Polymarket Money. Polymarket is one of these prediction market systems. It was retweeted, or it was posted by them over the weekend. That post has something like 700,000 views, and that seems to be enough to send these shares higher this morning. But again, can't stress enough, that is something that happened in December 2025, not May or June 2026.
I've been there too. It's always very important to make sure you check the dates on stuff to make sure whether it's current or old. That's interesting. Okay, you're also watching FedEx Freight, which is completing its spinoff and beginning trading on the New York Stock Exchange today.
That's right. And so this is kind of another oddity in the stock market so far this morning, and it's definitely worth just watching and calling out, because if you look at the kind of overall performance, best and worst in the S&P 500 this morning, at the bottom of the list, you would see FedEx, but it is spinning out its FedEx Freight business today, and it is holding on to about 20% of the shares in FedEx Freight as it spins that company out. So FedEx looks like it's going to be one of the worst performers, but in fact, it is spinning out this business. So worth watching over the course of the trading day today. FedEx Freight ticker is FDXF and FedEx FDX. Just worth noting that FedEx, if you see it falling, the news here is not additional competition. Oh, there we are. And it is, in fact, that it is spun out and finished spinning out this business, FedEx Freight, today.
Interesting. Okay, Bloomberg's Jeff Morgan joining us live this morning. Jeff, always great to have you. Thanks so much. Coming up, oil prices are climbing once again this morning as the week begins without a U.S.-Iran peace deal once again. We'll look at how this is affecting the Canadian energy sector when we come back. Stay with us. North American markets are trading in the green this morning, even as oil prices push higher. With the war now entering its third month, we are looking at what this means for Canada's energy sector. Joining us now is Garnet Anderson, Head of Portfolio Management at Tacita Capital. It's great to have you join us.
Thank you for having me. Good morning.
So we're watching what's going on in the Middle East. Thought there was maybe a peace deal coming last week. Once again, not the case. So still no end in sight for this war. With that in mind, and looking at the Canadian energy sector, have you changed your investment strategy over the last couple of months?
No, we remain consistent in our view. Now, there's a couple components.
Okay.
There are those firms like an Enbridge or a Capital Power, maybe a Cameco, that are tied into not just energy near-term and long-term and the whole AI thing. Then you've got really the energy, oil and gas producers in Canada that are a little bit more volatile, tied actually to the price that's moving around minute by minute. But when you take a look at those, sometimes you take a look at the estimates of what they're expecting energy to be carrying at West Texas or Canadian West, and there's too much pinning on what those forecasts are. So those will come in and out of our model based on momentum rates. Whereas when we're taking a look at an Enbridge, that's more of a cornerstone, consistent member of our implementation.
Got it. We're going to talk about all three of those companies coming up in just a moment. But just staying on the conflict in the Middle East for a moment, the longer it goes on, I'm assuming the better this is for the Canadian energy sector in total, or is there some caveats there?
Yes, it is, but it is still competing for consumer dollars.
Right.
And so if this was to be very prolonged and energy prices to get elevated, and again, oil is more of a global commodity, whereas gas is more of a, it's coming more global, but it's more like, North American kind of centric for us in which way. So as oil continues to go up, if that stays up higher for longer, that's going to hurt Canadian households, which would hurt the economy, and that could have a ramification in terms of portfolios. So it's not that we're immune to it. And then just in terms of changing our focus again, we're looking for a little yield, we're looking for a little consistency, we're looking for a little longer term contracts and different ways of playing it.
When you're looking at energy companies that are based in Alberta, I wonder if the whole conversation of separation of this referendum that's coming up later this year, if that weighs into any decisions you make around companies.
That is a fantastic question. And you could parlay that over to residential REITs and so on and so forth in Alberta. Not yet. Now, Canada has a history of this going back to Quebec.
Yes.
And that got awfully close. And companies were punished on their valuations that had Quebec-based businesses, and real estate and other assets were impacted. Right now, I don't think it's being viewed as something that's got a high probability of seeing its way through. And then what would be the reaction from the federal governments and the other provinces? What does BC do, for example? So I don't think that's yet priced into any of the current Canadian stocks or the earnings expectations.
You'd have to wait for an answer first and see reaction from, as you say.
You have to wait to see how the referendum goes.
Yeah.
And to be honest with you, is it a 50+1, which was the Quebec situation? How is it going? There's referendum and then how the results are read. And there's been a lot of debate back and forth and politicking around what's the question and how the question is going to be asked and if, when, and how sort of thing. But as to what the actual vote requirements are there, A, I'm not the expert on. B, I'd want to see that before I get too panicky. But right now, the market's not.
Okay.
99 things to worry about. I don't think the stock market is necessarily focused on that yet.
Got it. Yeah, there's a lot to focus on instead. Okay, we're going to go through some of your stock picks for today, all within that sector. Enbridge was your first one. Tell us what you like about Enbridge.
Well, Enbridge is, again, a cornerstone Canadian company, although it drives a lot of its revenues from the U.S. It's critical, transports about 35% of crude in Canada. And you kind of go, it's liquids transmission, so oil pipelines of another way. It's got gas transmission, it's got gas distribution, and then a little bit with a maybe spice on top or looking towards the future, it start to step out on really the renewable front. It's struck a deal with AT&T. It's now struck a deal with Meta down in Project Cowboy, as they call it. Great handle. So they're down in Texas and down in Wyoming, starting to walk through that. So they're at capacity for all intents and purposes. So what they're trying to do, it's not easy to build a new pipeline, as we all know in Canada. So they're trying to augment the system that they've got, branch outs. They're finding success down in the States in terms of being able to expand their capacity down there. And they pay out a nice dividend called about 5.1%. They look to grow that every year, called 2.4%. They've got a long history of doing that. And when you take a look at its downside profile compared to some of the others in the energy sector, particularly those are more commodity priced oriented, which always comes and goes. This is a little bit more stable. And so the downside, when we take a look at 2025, was about a minus 10%, which is relatively good compared to others. Now, like every kind of capital intensive business, if rates were to shoot up, that would not be good for any pipeline.
Of course.
Interest rates, sorry, to be clear.
Interest rates. Capital Power is your next one. So what do you like about this company and how is it faring in the kind of AI data center build out side of things?
Well, it doesn't have a deal yet. It has a memorandum of understanding to go negotiate a deal, a small deal on that front. They kind of got left at the altar a little bit in terms of Alberta's first phase one in terms of announcing access to grids for data centers. So it's kind of potentially next in line. So it hasn't really got the pop that maybe Pembina or TransAlta got. So you kind of say, well, that's powder in the keg that could come through. The other thing too is it's able to take advantage of some of this dislocation in the marketplace because it's got long-term contracts in place that basically covers its operating needs. And then has excess capacity that will then go and use and basically sell into the market at spot prices and run hedges and so on and so forth. So it gives a little bit of, when things are going well, has a chance to make some extra cream on the top sort of thing. And so it's a smaller dynamic. It's well liked by analysts. It's got, about a 15% upside to its 12-month average target. So it's well positioned, not without risk, but well positioned. But the main thing will be, can it be part of that phase 2 in Alberta and get that next? In the interim, going out, did a nice project in 2025 down the States, an acquisition of 2 in Ohio and Pennsylvania, increased its presence there, which is a positive. Its integration, if they can, I'll say, speed that up, that should make shareholders a little happier come the next 2 quarters.
Well, to be quick with your last one, but I do want to get to your last pick, and that's Cameco.
Cameco, long term. First of all, I think it's a faith type of thing in terms of, do you believe in nuclear, do you not believe in nuclear? If you don't, you're probably not very interested. I mean, it certainly is priced, expensively right now. But when it brought on its part ownership, 49% ownership of Westinghouse, it went from being pure kind of commodity to now commodity. It's a nuclear solution set. It can go from the engineering up to the design and implementation and fulfillment with uranium. So it's one of the leading global providers of uranium. That is still a commodity. But, if you're looking longer term as part of the solution set, 24/7 energy to the AI data centers, nuclear is probably part of that solution pack.
Hard to see if it's not. Okay, that's all the time we have. Appreciate you coming in studio.
Thank you very much
for your time. That's Garnet Anderson, Head of Portfolio Management at Tesita Capital, joining us in studio today. Friday on Market Call, we were joined by Brianne Gardner. She's Portfolio Manager and Senior Wealth Manager at Velocity Investment Partners of Raymond James, and she was covering North American large caps. These were her top picks: Celestica, Circle Internet Group, and Dollarama. Today on the show, we have Teal Lind. He is manager at Lind Equity Fund, and he'll be taking your questions on North American stocks. Just ahead, Canada's auto sector is facing fresh uncertainty as trade tensions rise and a new international partnership signals a possible shift. We've got more on that after the break. Stay with us. Tariffs and delayed talks with Washington are adding pressure to Canada's auto industry ahead of the July 1st CUSMA review. A new Made in Canada partnership with South Korea is now raising questions about whether Canada is looking beyond its traditional U.S. ties. For more on this story, let's bring in Judy Trin, senior correspondent for CTV National News. Judy, good morning. So do we know yet the content for this announcement today by South Korea and automotive manufacturing in Canada?
Lindsay, we are expecting to get more details about just how Hanwha, the South Korean defense companies, and the Association of Automotive Parts Manufacturers in Canada will work together to build military vehicles. What we know is that in April, the 2 groups announced that they were going to partner together as part of the bid, South Korea's bid to build Canada's next generation of submarines. So this is contingent on Hanwha winning that bid. But what we do know is that the Canadian Armed Forces is interested in buying at least 250 armored vehicles from Hanwha, such as the Howitzer K9 that it manufactures. Now, the company, the South Korean Defense Company, has thousands of orders from other NATO countries for these vehicles, as well as its other weapons systems. And this is about bringing Canada into the supply chain, being part of that manufacturing process. What we are expecting to hear is possibly where they are going to get the steel and aluminum needed for those armored vehicles. We are also perhaps expecting to hear in terms of where these manufacturing plants could go. If Canada were to start building these military vehicles, whereabouts? Would it be in Ontario, the hard-hit automotive sector, that part of southern Ontario? Would it be in Quebec? So these are some of the questions that will be asked, and we'll get the answers shortly after 11, Lindsay.
Okay, and it's interesting, too. I mean, we've heard the U.S. talk about how they want Canada to still have the U.S. as its main trading partner, its main partner within most manufacturing deals. So I wonder, when we're hearing about announcements with like this with Canada and other countries like South Korea, how this could maybe affect trade negotiations when we start them. Is it this summer for CUSMA renegotiations? Is there any impact, do you think?
That's right. Those CUSMA review begins July 1st. And what we know, Lindsay, is that since the U.S. started its trade war, 30% fewer automobiles have been built in Canada. So the U.S. has become this threat. As the U.S. moves to reshore more of its auto manufacturing south of the border, Canada has to come up with some type of contingency plan. So this is not about it angering the U.S. as much as Canada defending itself, providing a made in Canada solution to this. The Prime Minister, the government, even the automotive industry knows it cannot continue relying on the U.S. So this, in terms of moving into the manufacturing of military vehicles, what it means is it gives Canada another production stream. This will be very different. In an interview with Flavio Volpe, the president of the Auto Manufacturing Parts Association, he said that this deal with Hanwha, if it goes forward, could result in revenues of $10 billion over the next 2 years and thousands of jobs. That's the equivalent of building a new auto manufacturing plant in Canada.
Wow. Okay.
Lindsay.
We'll wait for that announcement at 11. That is CTV News' Judy Trin joining us live. Judy, thanks for that.
You're welcome.
Well, it's a sight that's surprising many, and that's plenty of tickets are still available for FIFA World Cup matches, both in Toronto and Vancouver, with the games less than 2 weeks away. CTV's Kamal Karamali has more on why Canadians are holding off on attending the games and the challenges businesses face in trying to reel them in.
It's been a lifelong goal for Joshua Cateau to watch a FIFA World Cup match in his own backyard. But those dreams dashed with one look at the ticket prices.
I feel like it really pushes the game out of reach for a lot of people who want to be there and want to show up. And it's really disheartening.
Lots of tickets for World Cup matches in both Canadian host cities up for grabs less than 2 weeks out. Canada's first match in Toronto not going for anything cheaper than $3,000, but other games ranging from $600 to just over $1,000, and that's just part of the overall cost.
Hotels are very expensive in Vancouver and Toronto. Airline flights are very expensive right now.
But it's not just the matches that aren't selling out. Vancouver's official viewing party showing large clusters of seats still available to its fan festival. Officials, though, not sweating it.
As people are starting to make and lock in their summer plans, we have quite a bit of confidence that people will secure their seats.
The cheaper option, coming here to bars and restaurants broadcasting the games, but getting official FIFA branding at your establishment, not as easy as it sounds.
You don't want to be necessarily using FIFA's big IP assets, nothing that sort of suggests or even comes close to suggesting that this is an official venue.
The City of Toronto's guidelines say businesses can't use words like FIFA, World Cup, or show the trophy to reel in customers, with the city able to issue fines or even late charges, unless they've partnered with FIFA's official sponsors like this Toronto bar.
We have brand partners that are directly associated with FIFA and the World Cup, and obviously it's through them and the tools that they provide that we're kind of bring the whole space together.
Those spaces, likely where these fans will end up.
It's really upsetting to see ticket prices where they are,
with prices still a bit over the top. Kamal Karamali, CTV News, Toronto.
Coming up, Berkshire Hathaway is buying home builder Taylor Morrison in a $6.8 billion U.S. deal. We'll get into that right after the break. Stay with us. Berkshire Hathaway is making a multi-billion-dollar bet on the housing market. The company is acquiring the home builder Taylor Morrison in an all-cash deal. BNN Bloomberg contributor John Ehrlichman joins us to explain Berkshire's thinking. John hosts the Ticker Take investing channel on YouTube, and he joins us now. John, this is the first big move by the company's new CEO.
Yeah, Greg Abel, the Canadian, no pressure, taking over for Warren Buffett. And obviously, especially with the cash pile this company has on any given day of the week, somewhere between $350 and $400 billion. A lot of people were wondering when Berkshire would want to make a move, make an acquisition. Everybody in the stock market seems interested in buying just about everything. But this is a classic Berkshire move in the sense that housing has generally been unloved. And we talk about the challenges in the Canadian housing market, in the U.S., where higher mortgage rates have really cooled down demand and building. This is one of those beliefs that over the long term, housing demand will come back. As soon as they need more housing property, you look to the home builders, and this is not the first time Berkshire has looked at this sector. They acquired Clayton basically 20 years ago, so it kind of fits the playbook.
And I wonder, too, with this news coming out, like whether this is going to maybe spark interest in other names within the home building sector, whether it's going to maybe start a trend here.
Well, you know, I'm glad we have this Berkshire example because recently on Ticker Take, and we've got a full write-up on the website, we talked about some of the home building stocks that are out there. Toll Brothers would be an example. Lennar would be another. Actually, both of these were recommended by longtime BNN guest Liz Miller, and she used a similar framework. And we should point out that Berkshire actually has held shares of Lennar as well. Just this idea that at the end of the day, there are some long-term trends. Housing remains one of them. In the current market environment, these kinds of names have generally been unloved, but do you really derail a long-term trend? Obviously, in the eyes of Berkshire Hathaway, you don't. Liz Miller has been a fan of names like Toll Brothers and Lennar. Maybe some value gets unlocked in them now that Berkshire is pulling the trigger on this multi-billion-dollar deal for one of their rivals.
Okay, BNN Bloomberg contributor John Ehrlichman, host of the Ticker Take investing channel on YouTube. John, always appreciate it. Thanks so much.
Thanks a lot.
Shares of NVIDIA are climbing on news of a new chip for personal computers. We'll break down what that means for the markets when we come back. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following for you in the BNN Bloomberg newsroom. Oil prices are rising today amidst uncertainty about a U.S.-Iran deal. The two sides have been trading messages about a draft agreement that seeks to reopen the Strait of Hormuz. U.S. President Donald Trump says it will all work out in the end, but Iran says a truce between Lebanon and Israel is integral to any deal. Apotex has launched its IPO. The Canadian drug maker plans to issue as many as 50 million shares at a price range of $20 to $24 apiece. The company is seeking to raise up to $1.2 billion. The IPO comes nearly a decade after that unsolved murder of Apotex founder Barry Sherman and his wife Honey in 2017. And Berkshire Hathaway is buying home builder Taylor Morrison in a $6.8 billion deal. The acquisition marks one of the first major strategic deals under new CEO Greg Abel. Analysts say Berkshire is betting the housing cycle will turn and that there's pent-up demand. The market currently faces elevated mortgage rates and affordability pressures. And we're keeping an eye on the TSX today. It is down to start the day by about 0.3%. So we'll continue to watch that for you. Also watching U.S. markets. Obviously, a lot of investors on both sides of the border very cautious about what's happening in the Middle East today. It seems as though it's not looking good at this point. All three of the major indexes there trading in the red to start the morning. Meanwhile, shares of NVIDIA are trending up on news of a new chip to bring AI directly to computers. It's another sign that tech continues to drive the S&P 500. So for more, let's bring in Jamie Wise, CEO at Periscope Capital. It's great to have you join us. Thanks so much.
Hi, Lindsay. Thanks so much. Nice to be here with you.
Yeah, so this news of NVIDIA making a new chip designed to power personal computers, how meaningful is this new development in the ongoing kind of AI story?
Well, it's just another leg in it. And really the way we think about things here at Periscope isn't so much directional, but the volatility around the narratives in the market. And AI is a big narrative, as you know, in the market. And this is just another data point for us all to consider in that narrative. And it is definitely leading the market today, but it leads it both ways. And we've seen that, right? There's lots of anxiety out there around the spend around AI and will it be monetized in a certain way. So far recently, we've had some constructive attitudes around that, but we certainly saw the anxiety around that just a few months ago.
Right. So what does NVIDIA have to do when it comes to this plan in particular to keep investors feeling positive moving forward, do you think?
I don't think it's a company-specific thing. I think it's just sentiment that's really driving these markets. And every single day, investors get a new data point that they can feel comfortable around and look through some of the other narratives that keep popping up in markets and causing anxieties. And right now, on the equity side, at least, we're living through a period of relative calm and positive sentiment. But the cross-asset volatility behind the scenes really stays front and center for us. And that's what's driving a lot of our positioning.
We're also watching for some big kind of mega IPOs this year, both from Anthropic and OpenAI. Those are just two companies. But to speak about those two companies in particular, how do you think those kind of mega IPOs will reshape the markets?
There's no question it'll have a big impact on the market, but unclear whether that will be a positive or negative impact. There's going to be lots of positioning that managers will have to get in front of ahead of those IPOs, whether that's rebalancing their portfolios to account for them, or even on the more passive side of the market where they are going to likely be a part of the major indices sooner rather than later. Lots of those index companies are making those changes to their index guidelines to allow for those things to happen. So there is going to be a lot of churn in the market as those large IPOs come to be, and to be determined how the volatility will react around all those things.
Is there one that you're more interested in than the others in terms of how things play out when it comes to some of the big IPOs?
Our approach here really isn't on the fundamental side to be directional around these things. It's recognizing that there's a lot of different narratives that have been happening in the market and wanting to build things portfolio construction wise that really offer convexity, that offer optionality to different types of outcomes. Resiliency is very important to us, and we recognize that and expect continued pockets of volatility to emerge in the market, but also understanding that those volatility pockets can be to the upside and to the downside. So we really try and position ourselves using options and other resilient forms of strategies and things that have convexity characteristics to them to allow for returns to be able to be harvested in either type of environment without having to take a big directional view.
We've seen tech AI stocks carrying the S&P 500 at the moment. Given the kind of volatility that you were talking about beneath the surface, is this leadership from tech AI sustainable, do you think?
Well, it's very interesting to talk about that because when you look at the Mag 7, they've actually underperformed the market this year. And so, you've had this rotation away from Mag 7, which many people a year ago thought might not be possible or the market would really take a beating if that were to happen. But we found other leadership. Right now, it's certainly in chip makers and semiconductors. Earlier in the year, it was more widespread. So I think that's a really interesting storyline to follow here is, can the market diversify away from either tech or the Mag 7 and continue its march onward? Again, something that we focus on a lot here is, just looking at what correlations are in the market, how high dispersion is, and how interesting that we have very low correlation, very high dispersion in the underlying market, yet they've grinded higher and higher and quickly reset from, those levels of anxiety just a few months ago. You mentioned some of the geopolitical churn that's happening in the market. We've jumped around from Greenland to Venezuela, and of course now all eyes focused on the Middle East. But when will those narratives come back and matter again? And will investors focus more on the geopolitical side of the market rather than the tech side of the market? Again, these are all things that to us just point to continued pockets of volatility. We're enjoying an upside pocket right now, but I think it's important to keep portfolios resilient against those dynamics should they change.
I wanted to ask you about that rotation away from the Mag 7, that kind of market dispersion that you mentioned, because some analysts feel as though there's about to be more attention on the Mag 7 once again. Were you surprised about what we've seen so far, and what do you think we'll see for the second half of the year?
Well, definitely the surprise over the last month might have been the strength in semiconductors and those chip makers really making up for the weakness in the Mag 7. We've had this theme. We kind of refer to this idea as narrative whack-a-mole that we've been living in over the last year or so here with all these different narratives coming up, and then you whack one down and another pops up. I don't think many people expected the demand to be so strong for the AI build, there was lots of anxiety around the cost of the build, what the Mag 7 was spending on that. Would they be able to earn a reasonable return on that massive spend? And of course, recently we've seen some of that come through where demand seems to be exceeding supply for now. But will that anxiety, that mold pop up again? We'll have to whack it down on the anxiety of just how much is being spent. I think that is still an unresolved question.
And just lastly, like with all this volatility and shifting narratives, how do you think investors should be kind of positioning themselves to withstand it all?
Add convexity into your portfolio. I don't think now is the time for carry strategies or strategies that expose weakness either in massively rising markets or markets that are falling very quickly. So to the extent you can use certain types of securities in your portfolio, things like convertible bonds, things like options-based strategies, things that naturally provide some convexity both to the upside and the downside, is a good way to harvest that volatility, because oftentimes the volatility that you have to ride through might not be worth the return that you're experiencing. So we're looking for other ways to harvest that and to lead to returns.
Okay, we'll leave it there. Jamie Wise, CEO at Periscope Capital. Appreciate your time. Thanks so much.
Thank you.
Coming up, we will take a peek into the business of FIFA. Stay with us. The FIFA World Cup is coming to Canada in less than 2 weeks. A new book explores the business of soccer, notably the star power of one player. Earlier, we sat down with Paul Tenorio, author and senior writer for The Athletic, to discuss the Messi effect.
He's upended what soccer looks like in North America since arriving here from a commercial standpoint. And we've seen all of that with our own eyes. Stadiums across North America selling out whenever Messi is playing in those markets. The #1 selling jersey in the world for Adidas. The valuation of teams like Inter Miami, of course, doubling, revenue tripling. That sort of impact is all in spite of the fact that Messi doesn't love to be in front of the camera. He doesn't love to show his personality. It's sheerly based on how good he is at what he does. The fact that he is a transcendent soccer player, and yet he has this magnetism that influences and changes businesses, and not just in the short term. This book really goes into the boardrooms of Major League Soccer as much as it does the locker rooms in Miami, to show how Messi's arrival and his impact in that commercial spike forced MLS owners and executives to examine the business of the league itself and to think about how to drive the sport and the league forward into the future.
Paul, it's Jeff Hull. I have a question for you. I deal a lot with the National Hockey League, the NHL, so I'm a little out of my water on football, soccer. But let me ask you a question in relation to Messi, his image, his brand. He seems to protect it so well when so many athletes in other sports tend to, and even within soccer itself, tend to have real struggles, either personally or professionally. What is it about him that's kind of made him like Teflon, that he seems to be able to navigate this and protect his brand?
It actually is quite remarkable when you think about how famous he's been for how long. He's lived in the spotlight as one of the most famous athletes in the world since he was a teenager. And yet, you're right, he has been able to maintain this sparkling brand. And I think part of it is just down to his personality. He is very quiet. He is very reserved. He is very family forward. And he doesn't really like to do things that some other athletes do. You don't see him out partying. He's never had those types of issues. And his family has been part of the business. His father has driven a lot of it because Messi is so protective of it. And I think that's really contributed to the fact that he's been able to protect the brand so much, obviously outside of some issues in Spain regarding taxes, but when it comes to kind of lifestyle things, even this decision around Inter Miami, right? He wins the World Cup in 2022 and he decides to come to Major League Soccer. Why? Well, because he wanted his family to have some semblance of balance, because it's not a normal existence to be Lionel Messi. They couldn't really leave their compound in Europe. And now, he's still not able to go to restaurants and things, but he is able to have a little bit more of a balance to his life.
And going back to, you mentioned about MLS had to rethink how they did things. What are some of the big lessons they learned from Messi, and how are they capitalizing on that?
Well, I think the most important thing is, as we know, all of these North American sports leagues are driven by media revenue. And Major League Soccer just doesn't have as much media revenue as the NHL, as the NBA, Major League Baseball, the NFL. And so while they've built a robust local business and they can put butts in seats at stadiums, they need to figure out how to now transition that business to attract more eyeballs on television. And Messi, the response to Messi has been so overwhelming that they've seen that there is, and this sounds simple, but it's a bit more than that, there is obviously this attraction to watching the world's best players in the league. And so they've reframed how they think about the designated player rule, which was created when Beckham came back in 2007. But they've also thought about what the product on the field needs to look like. And it's that simple. Major League Soccer, because we as consumers now have so much more access to the global soccer economy, we can watch the Premier League and the Bundesliga and La Liga and so many other leagues. We have more choice, and Major League Soccer needs to improve the product on the field. And so they flipped their calendar to be more competitive in the FIFA international transfer market. They're changing their competition structure to drive more games of consequence, and they're discussing changing the roster rules. And I mean, when you think about that, by the time Messi, from when he entered the league to when he left, for those three tiers to be completely different for Major League Soccer shows the amount of influence that Messi's arrival had, and the fact that it forced MLS to look at the business and say, we must mature, we must evolve.
All right, I want to talk a little bit about FIFA. The World Cup's coming. Toronto's getting one of the games. It's going to cost, I think, Canada $1 billion. Is it worth it in your eyes having the World Cup here?
You know, from an economic standpoint, I think that's a difficult argument. FIFA obviously has control of so many of the levers in terms of revenue to take so much of the profit away from these host cities and these host markets. But I think culturally, it is worth it. You know, coming from somebody who attended the 1994 World Cup as a kid in Washington, D.C., and seeing what the 94 World Cup did to create Major League Soccer and to drive interest in the sport, you know, Canada is at a similar point to where the United States was in 1994 in terms of needing to grow and evolve the game and to add more permanence to the sport in the country. And I think this World Cup can be that for Canada. Obviously, with Toronto and Montreal and Vancouver in Major League Soccer, with issues happening in Montreal and Vancouver about those markets, it's important to show the interest, to expose people to the global game, to kind of bring the best that soccer has to offer into people's backyards. I think the long-term tail, the influence of this tournament on Canadian soccer can be really impactful, but certainly for host markets and host cities, it's been, you know, a bit more costly than they maybe anticipated.
And is there one city you think that's going to benefit the most from this, just before we go?
Well, I hope it's Vancouver. I hope it's Vancouver because I would like to see Major League Soccer stay in Vancouver. It's a wonderful soccer market. They need to obviously figure out the stadium situation, but what a shame it would be if Major League Soccer left Vancouver. The passion that's there, I've really enjoyed. I've been to all three Canadian cities to cover Major League Soccer, and I think they really do add something to Major League Soccer. So I hope this is something that helps to continue to spur those conversations forward so that the Whitecaps stay in MLS.
That was Paul Tenorio, author and senior writer for The Athletic, co-hosted by Jeff Hull, senior financial advisor at Manulife Wealth. Coming up, Canada gets a failing grade on poverty, why food banks say this crisis is no longer temporary. More on that when we come back. Stay with us. Food Banks Canada is out with its annual report card this morning, and while there are a few bright spots, the overall picture is stark. A D+ for how the country is handling poverty. The report warns food insecurity has become a systemic failure driven by inflation, housing costs, and stagnant incomes. For more on this story, we're joined by CTV News' Renee Rogers. So Renee, tell us more about what this report is kind of highlighting here.
Hi, Lindsay. Well, this report comes to us from Food Banks Canada, and every year it sort of looks right across the country at the experience of people living in poverty and also what governments are doing to address it. And then from there, it gives Canada an overall grade, just like a report card. Well, this year, our grade is coming in at a D+, which is actually a slight improvement from last year when we just got a D. Now, as for what is behind those improvements, well, the report points points to the introduction of the grocery and essentials benefit, progress towards automatic tax filing, expanded dental care, and the strengthening of the Canada Child Benefit. But, this really overall is not a good news story with simply just getting a D+. And as you mentioned, Lindsay, this report really pointing out that these experiences are not just something temporary that's being driven by, inflation and just a blip. This is really pointing to systemic failures. So there's that D+ that you see on your screen. Here's one big takeaway also from this report, Lindsay, and it's this: 1 in 5 food bank clients have a job. They're employed, but still going hungry. So that's really showing us that employment is no longer a protection against food insecurity. Just a couple of other numbers I'll throw out there for you, Lindsay. 39% of respondents across Canada say they feel worse off compared to last year. 42%, close to half, saying that they spend about a third of their income on housing, and about 2/3, 66%, saying that government support is really not keeping up with the cost of living. So really, it might be a slight increase from last year, but overall, this is not a good news story.
Yeah, it's pretty dire, especially as you say, a lot of people now are using food banks that have jobs. Sometimes they have more than one job and they still have to use food banks. So when it comes to solutions, is there anything that the report is suggesting for Canada to kind of ease the poverty levels here?
Yes, so it's making a number of recommendations, and the first one it's making right off the top is that there needs to be permanent changes to employment insurance. It says the model that Canada currently is working from was designed in the post-war era for, people who had a job, a full-time single, job that sustained them, but it says that that's really not the case anymore. The labor force is shifting a lot towards more precarious, temporary contract work, and that is squeezing people out of being able to qualify for employment insurance. A couple of other recommendations it's making: doubling the Canada Workers Benefit, removing barriers, and simplifying access to the disability tax credit. It wants a federal parliamentary study on the adequacy of social assistance, which it says is not keeping up with the cost of living, and also closing the cost of living gap with the Canada Groceries and Essentials Benefit. And really, at the end of the day, it says that, if we want a strong and resilient Canada, it's only going to be as strong as resilient as, the people who need the most resources. So it really is encouraging governments to address some of these ongoing issues, which now it says are becoming systemic.
Okay, that is CTV's Renee Rogers joining us live to break that all down for us. Renee, thanks so much.
You're welcome.
Coming up, the Calgary Real Estate Board just published its home sales data for May. We'll speak with their chief economist when we come back. Oil prices are rising today amidst uncertainty about a U.S.-Iran deal. The two sides have been trading messages about a draft agreement that seeks to reopen the Strait of Hormuz. U.S. President Donald Trump says it will all work out in the end, but Iran says a truce between Lebanon and Israel is integral to any deal. Shares of Cogeco Communications are under pressure today. The Canadian telecom company says it expects to record a charge of $1.2 billion related to its U.S. telecom business. Cogeco says the charge is due to a write-down of goodwill assets amid a competitive environment. It says the impairment will not impact its cash flow or day-to-day operations. And a new poll from Nanos Research says a majority of Canadians want home prices to fall more than 20%. That figure jumps to 69% among 18 to 34-year-olds. The poll comes as the housing market has fallen back to where it was just before the COVID-19 pandemic. Analysts note, however, that prices are so far beyond middle-class family incomes, even with the recent drop. And we're keeping an eye on North American markets today. The TSX down by 0.4% this morning. S&P 500 also down after seeing some record highs last week, along with the NASDAQ, which also saw that on Friday, right now trading relatively flat. We're also keeping an eye on the price of oil. Take a look at where it's sitting now. It's up. It's jumped way up. It's almost up 8% this morning. And this comes on reports that Iran is going to halt exchanges of messages with the U.S. So this is driving bonds lower as well, causing stocks to waver, as you just saw. And it's also reflecting on the price of gold today, too. We'll take a look at where gold's sitting now. It's down almost 3%, obviously reacting to this news, which is casting doubt on any potential ceasefire that a lot of investors have been waiting for over the last couple of weeks. So keeping an eye on that. We're also watching the loonie this morning. It's falling amongst most G10 currencies. This comes as rate hike expectations relaxed after those kind of soft GDP numbers on Friday. The Calgary Real Estate Board just published its home sales data for May. And joining us now to break down the numbers is Anne-Marie Lurie, Chief Economist of Economic Analysis at the Calgary Real Estate Board. It's so good to have you join us. Good morning.
Good morning. Thanks for having me.
So tell us about the Calgary home sales numbers for May and if they were in line with your expectations.
Yeah, they are. I mean, sales activity has been slowing. I mean, we had been expecting this, especially since we were seeing, some pullback in migration numbers. And they're really just kind of returning to levels that are a little bit more consistent with longer term trends for our market. Other things to sort of note is a lot of that decline has been driven by the apartment condo sector, which has faced, changes just given migration changes, as well as just there's been so many new home activity. It is impacting the resale market.
Okay, I was going to ask, how significant is the downturn that you're seeing, but you're saying this is more consistent. Is that right?
Well, overall, when we look at our market, it's more consistent. So when we see the drop of, 15%, we got to remember this is really in line with longer term trends, with the exception of the apartment condo sector. This is the part that, sales are well below. They've fallen by over 20%. They're well below longer term trends for the apartment condo sector. And I mean, this is really the sector of the market that is struggling more so. Whereas when we go to the opposite end of the spectrum, detached activity is really just returning to something more in line with what we would expect for this time of year.
Interesting. You touched on it already as well. But when you talk about the lower population growth, how is that impacting home sales in Calgary?
We're really seeing this impact on the apartment condo sector, in part because we had such a strong flow of migration. And then with that changing, what it's done is it's really impacted rental markets. So that's slowed investment activity, especially in the condo sector. And at the same time, we were building to a level to meet those higher migration levels. So we've had record high starts for 3 consecutive years. And now that we've had that sudden shift in migration, that's really having an impact on that sector of the market. So that's slowing the overall sales, it's impacting inventories, and that's where we're starting to see some price adjustments happen.
Yeah, because that's so interesting, the record high housing starts that you've been seeing for the last 3 years, housing starts. I mean, how is that impacting? You talked about how it's impacting what we're seeing today in terms of those numbers, but do you expect that to have an impact also moving forward?
Well, what we're really seeing is that, with those record high starts, they're now starting to be completed. And again, the challenge is they're being completed at a time that it's, just as those migration numbers have come off. And really what that's doing is it's creating excess supply for apartment condos. I mean, when we think about the resale market, the impact is that, now people have much more choice. So renters can stay in rental longer. They're not seeing the same pressure on rental rates. Vacancy rates are rising. At the same time, we see that investor level pull back just because there is more vacancy rates. And then there's also, for those who are active, they have much more to choose from. So what we tend to see that happen is it impacts the resale market in a way that people are substituting to brand new, because that product isn't necessarily all that different. So especially in certain pockets of the market, we tend to see that impact be much more on the resale side.
And you said sales in detached homes down 5% over the year. Can you go into a little more detail as to why you think that might be?
Sorry, I missed that one.
Sales in detached homes, they're down 5% over the year. Is that right?
Yes. So sales on the detached side haven't seen as much of an adjustment. And again, this is a little different in part because, the detached market in some areas of the city is still favoring the seller. So we just haven't seen the inventory build because we have to remember that's not where there was a lot of starts activity. So the resale side of the detached hasn't seen that same boost in inventory levels in the same way. So this market is much more tighter. We haven't really seen as much for price adjustments. We're down slightly from peak, but again, peak prices happened last year. And that adjustment hasn't been much because the demand has stayed relatively strong. And I think the important thing to remember in our market is that even though migration levels have come off, our population growth is still positive. I mean, if we think about what happened on a national basis, population growth in Alberta still continues to grow. We still see flows from, interprovincial migrants from other provinces. And that's really supporting our demand at levels that, again, are maybe not as high as what we saw over the past several years, but are still consistent with long-term trends because we just haven't seen that same degree of pullback in terms of our population.
What about first-time home buyers? What are you seeing in terms of people who are looking to actually buy a home for the first time? I know in a lot of different areas they're sitting on the sidelines still. What's the situation in Calgary?
Definitely that sense of urgency has shifted a bit, especially for, existing renters because they're not facing, the rental rate increases that they had faced over the past couple of years. So we're seeing some of that activity slow. But again, when we look at overall our market, there is more choice in our market. It hasn't necessarily cooled off to the same levels. Like our demand levels are just returning to something that's a lot more normal, which again is very different compared to some other markets. While it's slower, this is not even as bad as what we've experienced. I mean, if I think back to, our pre-COVID 2016 to 2019 period, our economy was facing much more struggles then. We were seeing much lower demand in that time frame. So even though we're cooling to something that's not nearly as bad as what we've experienced before. And that includes for first-time home buyers. They have more choice, both in the new home and in the resale markets. And it hasn't completely cooled all their activity.
Okay, Anne-Marie Lurie, Chief Economist of Economic Analysis at the Calgary Real Estate Board. Really appreciate your time. Thanks for joining us.
Thanks for having me.
Coming up, we've got hot picks next. We'll zero in on 3 plays in the tech sector when we come back. Stay with us. Conservative leader Pierre Poilievre is calling for an emergency debate on Parliament Hill this week to address the recession. He says the Liberals have caused it. CTV's Jeremy Sharon has more on that.
In a Sunday morning letter to the Prime Minister, a push from Pierre Poilievre for Mark Carney to answer for the state of Canada's economy. Calling for an emergency debate in Parliament over the issue, you promised you would deliver the fastest growing economy in the G7. You delivered the only recession in the G7, wrote Poilievre.
This is a full-blown Liberal recession.
A Friday report from Statistics Canada showed the country's economy contracted slightly for a second straight quarter, meeting the technical definition of a recession. Poilievre lays the blame on the government.
This is people's lives. Behind these statistics are empty stomachs, empty fridges, and empty bank accounts.
We asked people in Ottawa what they think and what or who they blamed for it.
I do feel like times are tough.
It feels like a standstill, and a lot of people that you talk to, they feel like they're never getting ahead.
Are we really in this session as a result of factors that were the last 2-3 years, or is this a reflection of the current government?
Some economists poured cold water on the recession talk, arguing the declines are marginal and don't indicate a widespread downturn.
Economists tend to be very careful around using the word recession. The truth is that the economy is not in good shape. Through most of 2025, we struggled up and down.
But most are clear the country's economy is struggling to gain traction, and that can't be ignored.
We need to deal with this. The difficulty is that certain parts of the country are struggling, while other parts of the country really are faring quite well.
In a statement to CTV News, the finance minister's office called Poilievre's letter political theater, chalking up the downturn to external factors like the U.S. trade war and pointing to efforts to build new global relationships and attract major investment here at home.
That was CTV's Jeremy Sharon. It's time now for On the Radar, and IPO markets are in focus. Earlier, we sat down with Jeff Hull, senior financial advisor at Manulife Wealth. He says while IPOs can generate excitement and strong early demand, history shows they can also come with some volatility. Take a listen.
I can understand why investors do get caught up in the hype machine, because that is what an IPO ultimately is. It's peak hype, peak FOMO, fear of missing out, peak promotion. Because just like if someone was selling a house, you'd want to like cut the grass, wash the windows, stage the house properly to get the maximum price. That's really what an IPO is. They want to get the maximum value by taking their company actually public. So that's some of the pitfalls that the public has to be watch out for. But also, most IPOs, whether it's Facebook all the way back to even Tim Hortons, et cetera, you'll notice they go up quite a bit, but then they kind of start to falter a bit and kind of settle down after the hype is all gone and people moved on to the next thing. And then people always have to watch out for that 6-month cliff, I call it, that 180 days when a lot of the founders of the company, a lot of the shareholders initially are locked in the hockey penalty box for 6 months until they can sell their stock. And then they're all running to the fire exit at the same time. So there's a lot of weird maneuvers within IPOs people just need to be aware of, and then they can make wise decisions based on that.
Are there ones where you win when you buy right at the beginning?
Well, the ones that really tend to win are the ones that own the stock before the IPO.
The IPO,
so sure. SpaceX is coming out. There's just going to be a handful of stock available. It's going to be way oversubscribed for. But there's other ways to own SpaceX before the IPO. You can either buy companies like Alphabet, which is Google and YouTube. They own 7% of SpaceX. EchoStar owns about 2 to 3%, which is over half the value of their company, just SpaceX stock. But you can also look at competitors like Rocket Lab as an example. So as an example, on Friday, we had Blue Origin with Jeff Bezos' company. His main rocket test exploded right on the tarmac there. But sometimes people don't understand space. So Friday, a lot of space stocks went down a bit. I'm like, that's strange. It should all be going up because one of their biggest competitors just, literally exploded. And so that creates opportunities for other ones that will now pick up the slack, which is pretty incredible. It's an exciting area.
And there's some changes coming, too, with the IPOs, right, with the NASDAQ and NASDAQ Texas?
Yeah, there was the fast entry rule, which is kind of unprecedented, where usually the indexes like the NASDAQ 100 or the S&P 500, once a year or so they'll adjust it. The S&P might boot out 3 kind of low-performing stocks, but 3 in. They adjust it from time to time. This time around, the NASDAQ 100, as little as 3 days in, maybe as late as 15, are going to possibly push in SpaceX stock as an example. And that's an incredible situation, because what will happen is, as we talked about, if most of the shares are in a penalty box and haven't come out yet, and the public's going to go nuts for this when it first comes out, and then all these huge index funds, pension funds, mutual funds will be forced to buy SpaceX. Where is the float going to come from? So supply and demand is going to be way out of whack. We could see a big spike up in something like SpaceX at the IPO.
And I guess the big question, where's the money coming from?
That's one of the tricks, too. I think
we're talking 1.8 now trillion. Where's the money coming from?
You got it. So that's some of the opportunity or danger investors have to watch out for. What kind of investor will buy SpaceX? Does it tend to be age 20 to 36? They maybe own a lot of crypto. Maybe they'll roll out of crypto. Could be a big, amazing company like NVIDIA. They might want to just temporarily leave to play the SpaceX trade and go back to NVIDIA as an example. But one of the biggest areas of cannibalization I think could happen is Tesla. Elon Musk's other company, because everybody already loves Elon Musk there. They adore him. It's like, do they still bet on the car company, or do they jump to SpaceX? A little bit sexier, a little more interesting there. They may jump ship there. So that's why I think Elon Musk has said, we might merge Tesla and SpaceX together. I think he's saying that to try to discourage people from trying to make this hop, changing horses, that he owns both horses. It could cause a lot of disruption for him.
And does that provide opportunities? And for something that, we're not necessarily, NVIDIA is going to be the one where everybody pulls money out to go there, but is it something you should be looking for?
Yeah, absolutely. Because I think if someone did, let's say people pulled out of NVIDIA a little bit and made the stock go down 2, 3, 4%, just because some people are just gently transitioning over to SpaceX, suddenly you get NVIDIA at a discount for something that has nothing to do with them because SpaceX has an IPO. So sometimes these distortions or distractions provide professionals and the public opportunities to kind of take advantage of some things that are being unacknowledged or in the shadows off to the side. That's a great deal.
All right. And then other IPOs coming up, are they going to pay the price for SpaceX?
I think some of the nuances of how the SpaceX deal is going to be done is going to now infiltrate other IPOs. We've got OpenAI coming out probably around September. That's ChatGPT. And you got Anthropic, a great AI that'll be coming out as well. So some of these fast-tracking rules to add things to an index and some of the other rules, even Elon Musk added a little bit of a pressure valve. He's looking at if the stock goes up more than 30%, maybe 10% of those in the penalty box can kind of sell off a bit of stock to take some of the pressure off, to allow that freedom from markets and index funds to have the opportunity to pick up some stock in a less chaotic tornado that are IPOs.
Is there anything Elon Musk? Can there not be a chaotic
No, it's
tornado
chaos.
around
It's 24/7 chaos.
It's fascinating watching him. But so OpenAI, Anthropic, you still think they'll do all right?
Yeah, they're great companies. I think I'm more interested actually in Anthropic than anything else. And I think SpaceX is going to do very well. It's part of the future.
Yeah.
But space might be something for shorter term investors they could consider to roll into space. And after all the limelight and fanfare is done at the IPO, maybe they can drift into other areas as well. But space is interesting, but people got to look at the math. Because again, there's a lot of companies out there like the NVIDIAs are doing great things every day. And some space companies are kind of just there for a bit of a rocket ride and then they're done.
That was Jeff Hull, Senior Financial Advisor at Manulife Wealth. Coming up next, Hot Picks. We will zero in on 3 plays in the tech sector when we come back. Stay with us. It's time now for Hot Picks. Today, we are looking at the tech sector. For more, let's bring in Michael Monahan, partner and portfolio manager at Founder ETFs. It's great to have you join us. Thanks so much.
It's great to be here. Thanks for having me.
So let's get right to your first hot pick, because obviously the tech sector is incredibly hot right now. Dell is your first pick. What is it that you like about Dell right now?
So Dell is the play for agentic AI moving into the corporates. It allows you to have your own on-premise AI server to run the foundational models, to protect your data and keep it safe, yet take advantage of the compute power of the foundational models.
Okay, and you say all 3 of these picks that we're going to go through are riding different parts of the agentic AI wave. Is that right?
That's right. We see Palantir, Dell, and Oracle all riding the agentic AI wave, just slightly different places of that wave.
And before we go on to your next pick, I just want to go back to Dell, because what are some of the biggest risks that you think are facing this company right now?
So we see growth for Dell. We don't see a lot of near-term risks. If you look at the last quarter, the growth on their AI server business was absolutely explosive. And then with Jensen's announcement last night that he's partnered to bring the CPU, bring an NVIDIA CPU to the desktop, Dell will be one of the beneficiaries of that. So we don't see a ton of risks for Dell right now. We see a tailwind from both on-premises agentic AI and the fact that we're now beginning to run agentic loads at the desktop, and Dell's a beneficiary of both of those.
Okay, your next pick is Oracle. Tell us why you like Oracle out of all the names you could have picked.
Oracle is attacking the boring but profitable side of AI infrastructure. So right now we're compute constrained. The constraints are as tight as getting energy into data centers, getting the data centers energized to be able to push tokens out. And this is Larry Ellison, who brings that founder mentality, the type of investment that we do. He had the vision to see that the world would be compute constrained several years ago and starting building out his AI data center business. So he's ahead of the curve as more people want access to tokens coming out of these AI token factories. Larry really put himself to be there first, and that's why we're so bullish. The stock got punished earlier in the year, but the stock action is showing that people now understand that we're AI compute constrained, and Larry has positioned himself to take advantage of that.
Yeah, I mean, punished earlier in the year when we were talking about that whole kind of software sell-off we saw at the beginning of the year. There's obviously companies that are, going to win from AI in the software sector, and some that will be made redundant. I'm assuming you believe Oracle is one that's obviously partnering with the right companies and is going to make it through. Is that right?
Yeah, we believe that they've got several hooks. So hook number 1 is legacy systems that will be the trusted endpoint, storage, and proof of record for existing corporate data. And then number 2, a lot of these large corporates, if they're regulated, HIPAA, government data, et cetera, they can't put their data on a public cloud. So their only choice is to use their existing private cloud with Oracle or new Oracle private cloud. So they're very well positioned to take advantage of the growth.
Last hot pick is Palantir. So you mentioned this off the top, another one riding, a part of the agentic AI wave. Tell us more about why you like Palantir right now.
Palantir is very well positioned. The most important thing to remember for AI is that AI still requires really good human input. If you don't have human input, you get referred to what is colloquially referred to as AI slop. However, if you have a highly trained human operator on the front end helping guide the AI and then reviewing the AI's work, you magnify that human operator's capability. And with their forward deployed engineers, that's one of the things that Palantir is doing well, along with doing what's been a 20 or 30-year goal of a lot of business intelligence companies, and that is to take the disconnected data, whether it's living in an ERP system or a CRM system, bring it all together and make sense of it. And back to this theme of trusted endpoint, Palantir then takes the AI models, touches the existing enterprise software within the corporate, and is the trusted layer to bring that data out and analyze it. And then why we're so excited, the growth here is just really unprecedented. Rule of 40 went from 127 to 145. We think Alex will have a couple more quarters like that. And even though some of his retail investors have transitioned to chase the Microns and the SanDisks and the SOX complex, we think the institutional growth investors over the next couple quarters will come in. That's why the stock traded sideways and why it's been an opportunity for our investors and your viewers.
Okay, we will leave it there. Michael Monahan, partner and portfolio manager at Founder ETFs. Appreciate your time. Thanks so much.
Thank you for having us.
Prince Edward Island is facing a projected shortage of thousands of skilled workers in key sectors as a new initiative aims to help close potential gaps before they slow economic growth. CTV's Maria Saru has the latest in this report.
These students are growing human cells to help improve skincare products. And over in this lab at Charlottetown's Holland College, researchers are testing how much of one ingredient should go into a drug being developed. It's hands-on training for one of the industries PEI is counting on to grow. But the school's president says talent pipelines are under pressure.
What we're hearing clearly is there's a shortage.
A recent labor market assessment suggests that by 2035, PEI could be short more than 6,000 skilled workers across bioscience, construction, manufacturing, and digital and technical services. To help close those gaps, a $15 million gift from the Weston family is supporting FutureWorks PEI. The new initiative will add seats in high-demand programs, expand trades training, build cybersecurity skills, and support research to help businesses innovate.
There's all kinds of opportunities in applied research, and the college plays a central role.
While PEI has long been known for agriculture, fisheries, and tourism, labs like this one have helped turn bioscience into a major economic engine that generated more than $600 million in revenue in 2024. Much of that revenue comes from selling to global markets, including products and services tied to human and animal health. And the sector has big ambitions, hoping to hit $1 billion by 2030. To do that, PEI BioAlliance's CEO says the supply of workers must meet demand.
Companies that are based here that are looking for a highly specialized skill set will look at their home market first, but if it's not able to be found here, that particular skill set, they'll look elsewhere.
The hope is more learners will lead to more local expertise, so work with an impact well beyond the island can keep happening here. Maria Saru, CTV News, Charlottetown.
Okay, let's take a look at the markets on Bay and Wall Streets before we wrap things up here. The S&P 500, the Dow Jones, both trending down at the moment. The Nasdaq relatively flat. This comes after the S&P and the Nasdaq finished at record highs last week. We're also watching the TSX today. It seems to be dragged down by the materials index in particular. Materials is down by more than 4%, and you can see the TSX down by 0.7% to start the morning. If we take a look at some of the main companies on the TSX that are moving today, Parex Resources is one of those companies because the energy index is boosting the TSX up a little bit today. Obviously, we're seeing the price of oil really rallying this morning. Parex Resources up almost 9% at the moment. This comes after it completed its acquisition of Frontera E&P. So we'll continue to watch that, see if it can stay on top of the TSX today. We're also watching Athabasca Oil. This company has been rallying this morning, actually. It's up almost 6% to start the day, at the moment at least. This comes after a new $500 million 4-year facility has been expanded. It's expanding the Duvernay facility as well. So this announcement coming from Athabasca this morning, you can see investors seem to like that news. We're also watching Equinox Gold. It's down by more than 7% at the moment. So it's one of the laggers on the TSX. Discovery Silver is the biggest lagger at the moment, down by almost 8% as we watch the materials index just really lagging today. We'll continue to watch that for you. That wraps up this edition of The Open. Morning Markets with Roger Peterson is next.